Good afternoon, everyone. September 5th, market recap. So I wore my conservative shirt for everyone just for the occasion. Today, pivoting. How did we pivot in the markets to know to go short when everybody was talking about that the Fed's going to cut? Well, I thought I'd show you some of the reasons. Number one, what happened today? Non-farm payrolls. Non-farm payrolls came out. Sort of like what Waller said last Thursday when I did my early Monday video for you. He said he was worried about it being weaker than expected, but the markets didn't care. Why not? Because on the one hand, people are sitting there saying, well, the Fed's going to cut. And you saw it with the bond market going nuts. On the other hand, you start to have people saying, but it means we could have a recession. So the key is what stocks are going to give you the tells that the markets are going to perceive the weakness in the economy is more important than the Fed cutting. To me, the weakness in the economy is going to be reflected in the financials and the consumer discretionary stocks. And that's what you saw today. But you saw it before the markets went down. So let me show you what we're talking about. So on the left is the ES, the S&P futures. We're going to go and take a 2-minute chart. You're going to see the S&P futures right here on the left. That's at 9.4. This is at 9, let's say 40, 952. They were up here. So keep in mind here, that's up 30. Here, they're still up 18, right there at 956. But I was keying off the financials. Now, when I key off stocks, and I'm trying to key off what is affected negatively by the news, I'm going to take the most expensive stocks in the group because they move the most. So go and check out the Goldman Sachs and go ahead and check out what happened. Yep, it was up here, 757. Look here at 950, 8 minutes before the ES on the left started really going down. This had already sold off 15 points. How about JP Morgan? That one we were short. Yeah, guess what? Right here, right there. Already sold off 5 points. That's at 946. And so I'll put an arrow there for you. Right here, 946. Where was this 946? That was up in the stratosphere. That was here. It was still up 25. That's why I post on social media that we were shorting the SPX. Now, did I get out at the bottom? No. Should I have stayed in? And I'll show you why you stay in or why you do the law of twosies, where you buy two of something, you get out of one and let the other one ride. I'll show you that in a minute. But the first thing is the consumer stocks, the banks. First, you have the JP Morgans. Next, take the most expensive. Take MasterCard. What's MasterCard doing in here? MasterCard was getting destroyed. Already down 10 points. Now take something else. How about Capital One? Capital One was getting nailed. Well, how about some other consumer-oriented things? How about Marriott? Yep, Marriott sold off about 5 points really fast. How about Ulta? That's the ultimate in discretionary, no pun intended. Heck yeah, it sold off 8 points in the first 5 minutes. So all of a sudden, you were seeing that those stocks were nervous. They were nervous about the consumer, and that overwhelmed the ES. That was good enough for this to go down. Now, the next thing, and I promised you I'd show this, why did it stop where it stopped? Prior tops. And this was on one of my earlier videos. The more prior tops, the more you can draw a horizontal line, and the more important the support. See that green line down here? That was drawn before the opening. So let's go and show you. I'll show you an hourly chart. Here's the S&P on the left. As you see, prior tops. See those prior tops? That becomes support. If you put the SPX in non-24 hours, it's even more dramatic. Go and check this out. You remove that and take the S&P and go and take this on an hourly chart. You can even take it on a 15-minute because this is non-24 hour. You see it here a mile away. Look at those prior tops. So you got the prior bottoms and the prior tops. That becomes a zone. That's your zone of support. And that's where it stopped. So a lot of people saying, oh, it's going to go to here. It's got to start here. And also, then what else do? We combine things. And what do we combine? An oscillator. So when you saw the oscillators get oversold, you could see that a mile away. And you see them oversold that much on the bottom. And at support, that's not where you short it. That's where you cover your shorts. Now, why did I cover my short up here? Heck, beggars can't be choosers. I was taking 45 points. If I had twosies on and had more than one of the S&P futures, you buy one back in here, and then you go to a shorter term chart to time where you get out of the rest. Let me show you. This is also on a different video, and this is what I mean about combining things. So number one, you have the MACD. That was on a video. Oversold. On another video is about support. So here you go. This is pretty exciting. At least I find it exciting, but everything with the markets I find exciting. Oversold at this support. You see the support now a mile away. It's a zone. It's not an exact price, but there's your zone. So it got oversold at support. Then what you're going to do is cover by timing the entry with an ultra short-term chart. So let me show you what we're talking about. Go to here, and now go to here, like I said. Could you have gotten out anywhere in here? No. Could you have gotten out right here? Yeah. Right in there. Well, that's where I got out. Could I have had the next leg down, make an extra 20? Sure. But I took the profit when it got over that dotted line. Like I said, I love using the ATR trailing stop, but when everything goes crazy, you need to have a shorter term pattern. And the reason is, if it goes down too fast, the average true range widens, which means it's not that good a stop indicator. As you see right here, if you waited till there or down here, that's about 20 points. So when it moves fast, use a shorter term moving average. So what do? That's where we covered. So what do you do for next week? That's the big kahuna. Well, the way I look at it is this. You have 1 day down. That's nothing. But I think the big deal is going to be buyback blackouts. I know I've been a broken record about that, and I've talked about them ad nauseum. But you saw with JP Morgan. What this means is when companies are in their buyback blackout, 5 weeks prior to earnings, it means bad news is more likely to rock a stock. As you see, September 8th, that's Monday, is when they start not buying back stock. So it doesn't mean that it has to go down, but this type of news like today is more likely to affect it negatively, and that's exactly what happened. There's another way to find that. You can sort of see the violators, the ones that are buying back stock, because they can't buy back stock on the opening print, and they can't buy back stock the last 10 minutes. This 5-week thing is voluntary, but most companies adhere to it. So just keep that in the back of your mind. But what happened the last 10 minutes in JP Morgan? Pretty dramatic. We're going to take off the drawing and go check out a 1-minute chart. When did it start taking a dive? Guess what? 1550. Yep, a violator. So they were buying back stock the end of the day. Yeah, I refused to go any lower. And then they nailed it on the last print. Goldman Sachs, the last 10 minutes went down about 3 points. We shorted it before 1550, anticipating that. We were short right here, right there. And then we covered market on close. What else had a violator? Apple, 1550, straight down. All afternoon it held up until they didn't buy back stock. So just keep that in mind, the back of your mind, that Goldman Sachs, Capital One, American Express, JP Morgan, they're some of the earliest to buy back stock because they have earnings, and they're the earliest to be in the buyback blackout. JP Morgan starts on the 8th. That's why I think the overall markets are going to be more rocked by bad news at the end of September and into October than they are now. It did hit them, but it's hitting the ones that have the looming buyback blackout first. Hope you like this video. Yeah, speak much, but I hope you like the video. I'll have more next week. Take care.